Friday at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then, independent advisor Sharmila Joshi and Vineeta Sharma of Narnolia Financial Securities join us on the show. Thank you to both of my guests for joining me. Today on Hot Money, we'll discuss the stock of the day, and that is Avenue Supermarts. It's down 10%. What should one do with it now? We'll discuss about the IT sector now that Infosys and TCS, both of them have come out with results. What's the way for the sector going ahead? Since we're in the earnings season, we're asking them one stock that can outperform the earnings season this time around, and similarly one stock that can actually underperform this time around. If they have multiple stocks, yes, they can speak about it. But that's the broad way we will discuss the stocks in the show today. But let's start with the first stock, and the first stock is obviously D-Mart. Came out with a very weak set of numbers. It's down 10%. So this shows that, you know, stocks with extremely high valuations, they leave any room, they give you hardly any space for any kind of error, and if that happens, it goes down by almost 9% in trade. You saw that happening with multiple stocks. You saw that with Page last quarter. You saw that with Eicher in its numbers that came out, the monthly sales number. But overall, Avenue Supermart was a weak number. EBITDA, the margins declined by 200 basis points. Management gave their explanation in terms of, you know, longer working hours. They gave the other explanations in terms of inventory, but the market certainly does not seem to like it. Profit growth of just 2%. So the focus now certainly seems to be on the top line growth, 33%, but that's not contributing to the bottom line. So we'll ask our guests what they firstly felt about the numbers and what should one do about Avenue Supermart. So Vineeta, I'll start with you. What did you make of the numbers first before we decide what should happen next?
So definitely, Darshan, we were not expecting this kind of a PAT growth. We were expecting around 18% PAT growth for D-Mart, and the sales growth is robust. And as it is there in the management discussion that there were overheads because of the festive season, and that had led to the EBITDA margin degrowth, and gross margin went down because of the pricing, the price cuts that they have taken. On the PAT side, if we see that there has been lower other income, and there has been interest charges which has gone up during the quarter because of the NCDs that they have been continuously raising, and that has done overall that has dented the profit scenario for D-Mart. As regards D-Mart, if we look at it, the overall the revenue growth looks quite robust, and EBITDA margin declining or gross margin declining was little bit understood, because management has continuously said that margin is not the concern from them, because that is their target to get the cheapest thing to the consumer, and that has been the target for the management. So going forward also, we will not expect the margins to revive from here. It could be somewhere around this range. 4.5% net profit margin should be a place where some kind of comfort should come. The valuations definitely are high for D-Mart, and as you said, there is no room for any error on that side. So somebody who is retail as such, the kind of brand presence that D-Mart has made for itself, getting the lowest product to the customers, and the sourcing is very beautiful. I mean, the kind of sourcing that D-Mart does for its customer is very good. They are not very aggressive in store opening. They are going slow because they have that broad thought in mind that unless until they have the sourcing right, they will not just go and open a store and get the numbers very fast. So it's kind of it's trying to place its brand very clearly as to what D-Mart stands for the public. So definitely there are hiccups, going to for the long run, what brand presence you want to make. There are certain hiccups on the way, but then I think if somebody wants to have a long-term bet on the retail, which we see a very big fortune for India going forward, one can still stick to it, or one can, any 15% dip should be an accumulation point for
okay, so that's what you're telling your clients, accumulate or decline. Even after this result, have you all changed your targets or estimates on D-Mart?
Definitely we have, because as I said, we were not expecting, we were 16 to 18% PAT growth, was that what we were expecting. And right now we have reduced our estimate by around 8% for FY19, and for FY20 we have reduced our PAT estimate by around 5%. But still, and that brings the target price for 1 year little down. But somebody who wants to have a long-term view on the retail and somebody who wants to stick to the thematic side of it, I think D-Mart is a story to stick on.
Sharmila, would you agree? What's your view on D-Mart? What did you make of the numbers? Were you also as surprised as everyone when they came out with numbers?
So, honestly, this is not a stock which market has ever looked at from purely profitability and, that kind of an angle. It was always more of a sort of a reaffirmation or a big thumbs up for the fact that Mr. Damani was such a big investor, and you always had a premium valuation for the stock because of that. And now what we've really seen is not 1 quarter but 2 quarters of bad margins. So, I don't think that it's really restricted only to this quarter, but it's a hangover from the, I think the previous quarter also the margins weren't particularly good. Number two, I think, coming back to what you were referring to earlier, you had this correction across a lot of these fancy names, whether it is a Page, whether it's an Aisha, which are always trading at premium valuations. But this was one stock which had not corrected too much. So I think, now it has a double catch-up to do. One, on the downward side, that is, because it has a catch-up to, because it has to come in line with the new reality of the valuations that these numbers are giving you. Plus, it has to correct because, as you said, there's no room really for error with the kind of valuation that you are doing, which is what is the worrying fact for me. So I think you'll have to now wait and see what is the level the stock finds, because it will find its level, and it is a fancied stock, and I think market will continue to like it. And if you remember when it was doing well, what are the kind of valuations broking houses were talking for this stock, what multiples they were talking of for some 10 years down the line and things like that. So till the market gets back to that mood, I think you'll have to wait for the stock.
Should someone?
So I would say stay off. I would say just stay off. Let the stock fall. Let it do its come to some semblance of where it is sort of moving sideways. Then look to enter.
So no, someone who's looking to take a slightly longer term perspective, should they accumulate now or should they accumulate?
I think you have to wait. You have to clearly wait. I think what Page and Aisha has told you is that you have to wait.
Okay, they corrected 30, 35, 40%.
Absolutely. Okay. And this stock had hardly corrected. So the correction has just begun.
Okay. Vineeta, just before we move on to the next stock, because of what D-Mart came out, has your view on the other retail stocks under your coverage, has that changed? Are you all looking at it that, with caution for that sector now?
No, not really. Yeah, definitely a little bit on the margin front. We'll have to rework on it. But then I don't think, because D-Mart has played a strategy, and which is clearly and there is competition in the market, but like to like, if I say D-Mart with any other company, so most of the other retail that we are tracking is one is Trent, which we cannot directly compare with D-Mart. So I would not say that because of D-Mart will change a lot of estimate, because D-Mart is playing a strategy of, and last time also we had corrected our margin estimate, but though we couldn't correct it to that level, somehow we just missed that thing. But management is very clear that they will give the lowest product to the customer and the best sourcing that they will be able to do. So I think 4.5% net profit margin should be a stable one for D-Mart.
Okay, so that's the view that's coming in on the first stock, and that was Avenue Supermarts. Let's move on to the second one, and the second big number that came out was Infosys. Obviously, the share price here didn't react as much as the ADR. The ADR was up 8% at one point of time. It finally settled at 5%. What we're seeing on Infosys is up almost at 2.5%. Now, two things came out of Infosys. While the numbers, the margin again, like TCS, came in below what the street was anticipating. What played for the stock was the buyback, the special dividend, and surprisingly the revenue guidance that they upped. So that is something that worked in favor of TCS and in favor of Infosys and not TCS. What we're asking our experts right now is, since the two big numbers of the IT sector are out, you can pretty much judge how the sector will pan out through the entire season, and that's what we want to gauge. Sharmila, two big numbers out now, and you'll have a fairly big idea of how the others will do and how probably the mid cap will do. What's your sense of IT? Seeing these two numbers, are you seeing pain with margins and the financials of the entire IT sectors that will come out now?
Yes, I think that seems to be like a clear takeaway, because I think Infosys had sort of protected their margins for the longest time, and this is perhaps one of the few quarters where we've seen that. I think the good news, of course, is what you were alluding to earlier, that they've actually upped their revenue guidance. So I think that's what we need to focus on, because they've upped their revenue guidance. And I think if you look at the numbers of both TCS and Infosys, the comfort that it gives you is that the order wins are very good.
Achha.
And their client wins are good, their order wins are good, and honestly their commentary, because they do get a fair sense of how clients are thinking, because that way you're now 15-20 days into the month. So I think that also, though they may not talk about it, because obviously they can only talk about things they sign, but it gives you a fair sense that they are not very unhappy with what they see in the pipeline. Otherwise nobody will go and raise a revenue guidance. So I think net really not much. I mean, though market has preferred Infosys numbers over TCS, according to me there are some overhangs that linger for Infosys, given the fact that you had that whole issue with the top management shakeout, and we really haven't seen any logical conclusion for that, in terms of answers as to why that happened and what's happening with Panama and what's happening with Strava, etc. So I think that I own both stocks. I like both stocks. And as I said, I continue to prefer the large cap over the mid cap.
Okay, so among your valuation perspective, so to your clients and all, are you suggesting only the large caps? Are you seeing any bit of caution on the mid caps, and will the entire? Are you concerned about how the others will come out with numbers, because margin drop was seen in both of them?
Yes.
So is that a concern that you have, that probably there could be a de-rating of the sector as such?
See, in any case, my view with mid caps was that you needed to be little stock specific. It was not that you go out and buy any mid cap. And I think this is precisely the concern, that when things like this happen, mid caps tend to take it more on the chin than the large caps, because large caps have a more diverse geography, more diverse vertical spread, etc., etc. So I think within the mid caps there are certain stocks that I have recommended. I would wait to see the numbers before you buy further. But stocks like Tata Elxsi, though the numbers weren't very good, Persistent System, stocks like that. And coming to large caps, I think I think even last Monday we discussed this. I like HCL Tech actually. So if I had to bet on a stock that could outperform, it could be HCL Tech. So you need to wait to see how they really develop that products business that they bought. But that if they could do that well, I think they could probably outperform the other large caps.
Okay, so what's your pecking order? HCL Tech tops it?
No, I think the order will still be TCS, HCL Tech, Infosys, and then Tech Mahindra.
And not Wipro.
No, Wipro, I've never considered buying.
Okay. What about you? What did you tell your clients after the two big numbers that came out? And what's your overall strategy in recommending IT to your clients now, after seeing these two numbers?
So, for Infosys and TCS, the order book as well as management commentary towards the macro environment and the demand traction is pretty good. So we are seeing good amount of sales growth. Not good amount of, though a stable sales growth for IT companies going forward. Margin definitely is a concern, because reskilling will be costly and it will not be that easy because of digital taking over. So the reskilling of employees will take a good amount of time. I think 4 to 6 quarters is place where the margins will remain under pressure, or a little lower from what we have seen right now, because Infosys also said that they are going to continue the investments into training. Also the subcontracting costs are going up. So these are the things that will keep on going. Like last time when we had seen IT perform with 30% growth in 2005, 6, 7, that kind of phase, that was the time only application development was a main revenue. So now the digital has taken over. Digital is now 30% of the total revenue for Infy TCS, and that is growing at a 33%. So that gives a cushion for the top line to grow around 10 to 15% overall top line, and the main segment is growing at a 33% growth, which gives confidence. Now for the margin, definitely there is a change in the structure. So digital digital demands a different kind of skilling of the employees, and with all these visa costs, etc. So margins are under pressure. 4 to 6 quarters is what we are expecting this kind of thing to stay on. Basically for us, IT would be more of a value stock because of the dividend yield and the buybacks that will keep coming in because of the good cash flow that these company has. As regards growth, I would not say it's a very growth oriented sector as such, wherein you can just get in at a. So I think dividend yield and that should be the right way to look at IT right now.
Okay, what's the pecking order for you among the large caps at least?
Pecking order is Infosys first, then we have LTI, and then Tech Mahindra.
Okay.
So Tech Mahindra also we're liking because of the low valuation right now. Also we are seeing some kind of communication segment to pick up, and the 5G rollout will be slow, but then it will stay on. So it will give a little bit of stability to the company going forward.
Okay, that's the view. Sharmila, just before I move on, I think I heard you nod when she said digital. You also bullish on the digital players?
Yes, also, and I think that this is a big plus point for the large cap IT companies, because earlier they had that catching up to do because the mid caps were sort of more nimble in getting into the digital space, but now it is 30% of their of the business they do, and I think that's definitely as we were just discussing even before the show, digital is the way to go. So that is clearly going to be a segment that's going to offer new business to companies. And to just add to Tech Mahindra, I think my also concern on Tech Mahindra is the fact that they have a lot of exposure to Europe. So while this Brexit thing remains unresolved, now that I think will be a sort of an overhang for Tech Mahindra, though it's a company that I really like. And I think that way they're probably close to their 52-week high at this point in time. So that is why it's like 4th on my list. Otherwise, it would have really been higher on my list than Infosys.
Is it a valid concern, the Brexit thing?
So Brexit actually, as what we have been talking with the management or what we've been hearing, in fact, Brexit would be rather a benefiting factor for Tech Mahindra. Because that's because the rules that they will change, and it's supposed to add more of order book, and that's a thing that we have. In fact, I think that should play in a favorable to the company going forward.
Okay, so that's the view that's coming in on the IT sector. Pretty comprehensive discussion on the two large caps and the other names that are there in the IT sector. The next thing we want to talk about is that we're in the midst of the earnings season. We're asking them one stock or a couple of stocks they believe that they're watching out for this earnings season and probably have the potential to outperform this time around. So Vineeta, which are the stocks? You all already came out with this big preview note also. I was going through it. Which are the few stocks that you believe that investors should watch out that this time around can surprise on the upside?
So one segment that we are liking is the corporate lenders, and corporate lenders on the financial side, because a lot of NPA provisioning has been done, and most of the corporate lenders are now giving loans to the loan book is now in a better rated corporate. So Federal Bank, as we see, so AAA rated portfolio is now 70% of the corporate loan. Also, the slippages have reduced, and most of the NPAs that is coming, it is within the slippages is coming within the watch list. So that ways we are liking corporate banks as such, and within that segment we are liking SBI. So I think one company in this result season which should surprise us should be SBI, because net interest margin, which has been under distress for a long period of time, that should catch up, and this time we are expecting net interest margin to improve because of the MCLR resets. Also on the cost side, better CASA franchise. On the yield side, retail liabilities is increasing more, retail assets are increasing more. So one, net interest margins is getting protected, and second, we are expecting good treasury profits for SBI this time around, and that should surprise the market with the correction in the bond yield. Though little bit it's gone up, but overall for the quarter, if we see, So good correction in the bond yield should give huge treasury profit to SBI. So these are the two reasons which will, which will make SBI report a good net profit for the company. We're expecting around 5,000 crore of net profit for SBI for this quarter.
What about the asset quality? Is that not a concern, or you believe that this time around it will be eased?
So asset quality definitely, I mean, it is a concern, but then the kind of provisioning that the company has done is, I think it will take care of it, and I don't think it will go deteriorate further from here. Also the ILFS, they have exposure around 4,500 crore, but then most of it is into running SPVs. So that also one overhang which is capturing all the banks. So in that case also SBI should be at a relief. So that's the reason, and it's trading at a pretty low valuation. Safely we can assume 1.2 times FY20 price to book, which will give around 350 target.
Okay, so that's the view. SBI is something that Narnolia Financial expects that will outperform this time around. Sharmila, which is a stock that you believe can surprise this time?
First of all, I really don't have, what should I say, I'm not so sanguine about this entire earnings season, because I think that barring some companies or some plays or going ahead at least, because I'm not expecting the next 5-6 months very honestly to be very good. Also, I think a lot of stocks coming this festive season has not been that great. So, your standard sectors which were giving you decent numbers, whether it was autos, those are not going to give you good numbers. And I'm not at all satisfied with what is happening on the whole banking front. Because I think for me, there are still many concerns there with NPAs, etc. And I think that, of course, I think ILFS is a big concern. I mean, just look what happened with IndusInd Bank, and they should have provided for it entirely, etc., etc. So to cut a long point short, all I'm trying to say is that the one sort of safe sector which I think that one hears of is the consumption space, and the sort of the conventional FMCG play. So stocks like an HUL or a Dabur or something like that is where I would think could outperform in this earnings season.
Okay, fair enough. So that's the view that's coming in. Consumption space, something that Sharmila spoke about, and SBI and Federal Bank is something that Vineeta spoke about. So we'll move to the next side of the spectrum, and that is companies that could disappoint. Some of the companies have already come out, so you can't say D-Mart now. But which one? You sounded quite pessimistic, so I think you'll have some companies here.
No. So I think as a sector, what I think is definitely going to underperform is going to be metals, because till you have that March deadline, which is looming on you with the US and China trade talks taking place. I think this is a no-brainer that this sector is going to stay within a range, irrespective of what numbers they give, because they are completely going to react to international news, and that news is going to be depending on which side of the bed Mr. Trump gets up. So he's going to come up and say something, and that's going to throw everything for a toss. And even if you get a positive outcome from that, I think for metals, the scenario is not as good as it was 2 years back. So domestic demand is decent, but I think even internationally prices are soft. So I think this could be one sector that could outperform.
Okay, metals metals could underperform, and remember, most of the metal stocks are now trading at a record 52-week low. Sorry, not record, at a 52-week low. So there is negative traction that's happening because of what's happening with China, and which according to your report that you all came out, which is the sector that probably will have most pain this time?
So one sector, because it had been doing very well, is the auto sector. So it has been the favorites of most and also for the portfolio managers, because it's a big sector. But then for this quarter or next 2 to 3 quarters, we are expecting autos to underperform. And one is the volume growth, which has been not very encouraging. There has been sluggish volume growth for most of these companies. If you look at Maruti, the volume growth was 1% in the domestic side, minus 25% for this quarter on the export side. Hero Motor came up with only 5% volume growth. Or Eicher, I think also is of minus 4% volume growth for the RE. So volume growth has been under pressure. Along with that, the cost of ownership has increased. So it's difficult for the companies to pass on the realization increase. So it's difficult for the companies to take price hike. So the way Bajaj Auto has, targeted to achieve more market share, it is obviously it is having pressure for Hero Motor or TVS to strategize as to what price hikes they would get into. So secondly, with more regulations coming in, cost will increase. So ABS, CBS technology, or BS6 implementation, all these will have cost pressure on the companies. So volume growth is not there, margins are under pressure. So I think with the kind of valuations that they are having, that should suppress a little bit on that side. So for all these, we have a neutral view on auto as such right now.
Okay, so that's the view that's coming in, or as far as the sectors are concerned. Metals as well as auto are pretty much the two sectors which our experts believe this time around could underperform. But with that, it's a wrap on today's edition of Hot Money. Sharmila, thank you so much for coming in. Vineeta, thank you so much for coming in. Ask BQ comes up next. Stay tuned to Bloomberg Quint.